Hello and welcome to Profit Top Trades. I am Puneet Zaveri. With me is Anushi Vakharia, and over the next half an hour or so, we'll tell you everything you need to know about the markets. We also have a very special corporate conversation lined up with Kalpataru Projects. But before we go to the management, Anushi, how were the results essentially for Kalpataru? If you can just give us some highlights and then welcome in the management as well.
Right, so for Kalpataru Projects, I'll start off with the headline numbers first. While we were seeing about in-line sort of a revenue growth at around 18%, margins have remained flat this quarter at the levels of 7.6%, and net profits saw, however, 37% of a growth. Now, coming to the order book positioning of the company, they reported about a 10% of a growth here. Order book standing at 64,495 crore as of March 25. They received new orders worth about 2,372 crores till date in FY26 period. Order inflows, however, for FY25 stood at 25,475 crore. In terms of how the segments have performed, now T&D, transmission and distribution, has remained on the stronger side for the business, along with buildings and factories. Also, we've seen about a 20% plus of a growth here, but it was water and railways where we've seen a bit of pressure throughout the year. So commentary on that is something that we should be watching out for. In terms of what the outlook forward is, let's welcome in the management Mr. Amit Uplenchwar, the director of Kalpataru Projects. So Mr. Uplenchwar, first question, your assessment on the fourth quarter. Now we have seen margins majorly remaining in line. Revenue also, the expectation was also of 18% of a growth, and we see this. So just give us your assessment on FY25 as a year.
So first you asked me for Q4, so let me start with that. I think it was an exceptional Q4, a blowout quarter for us, and I'll tell you why. Because we've got revenue, EBITDA, PBT, order book at an all-time high for Kalpataru Projects on a standalone basis in Q4. If you see, we've crossed 7,000 crores in revenue at console level, which was the first for us. Our EBITDA in absolute numbers went up by 19%. And our net profit went up by 37%. So all in all, a great Q4 for us, and made up for a little sluggish Q1, which generally is for our industry. And I think if you see the whole year gone by, FY25 from on all counts was for us quite heartening. We achieved our order guidance of 25,000 crores for last year. We said we'll be between 4.5% to 5% of PBT, and we were towards the end band of 5% thereabouts. So that was a good number that we achieved. If you see in terms of revenue also at a console level, we were at 18% in spite of a dip which you just showed on your screen a little while ago on the water business, which was a drag at 30% then year on year. And that was a temporarily yearly blip, a sectoral problem, which is now hopefully getting resolved in the next 2 quarters. And that should be back on its regular growth trajectory as well. So I think we've been able to achieve all our guidance parameters of FY25, and the trend of Q4 looks very, very promising, because of which, as management, we are very, very bullish that next year we should be able to get in FY26 a revenue growth of 20% on a very high base already, both for standalone and console. And we are also pushing ourselves to increase our margin profile to go on a standalone basis from 5.25 to 5%, 5.5% PBT, and on a console level of up to 4.75% for FY26.
Okay, so Amit, this 20% of revenue growth that you're expecting in FY26, along with this margin expansion, which are the segments that will contribute to this growth? Would the focus remain on the transmission distribution side of it? Would it be the export business, which would drive international business, which would drive the revenue growth? If you can give us more clarity on that as well.
So as you mentioned, our T&D business, both domestic as well as international, is seeing huge order wins already last year, which gives us enough visibility for the next 2-3 years from a revenue perspective. So I expect that growth to continue. Our buildings and factories also is sitting on a very large order book. And again, those kind of 20% growth expected in FY26 as well. Oil and gas, we grew at 114% last year and over 150% on a YOY basis in Q4. And I think this year as well, we expect very, very robust growth in oil and gas. Water, hopefully, it all depends on our cash flow situation, and hopefully we are expecting by Q2, Q3 as an industry, what we get advised is that monies will start flowing in, because there is also a very large sectoral allocation from government in current year budget to around 70,000+ crores. So hopefully we grow at 10% in our water business on a very conservative business, which can hopefully get better if the situation with receivables gets better. So that's why we are very confident that we should be able to get 20% growth already on a standalone closing order book, or revenue of almost 19,000 crores last year. 20% would be a big, large jump.
Okay, so you've talked about water business. You started seeing improvement from the second quarter onwards. So if you just had to project, like for FY25, while we did see about a 35% of a decline in terms of where the revenue is, what is the kind of growth that we expect for FY26 coming back for this segment?
So, we ourselves have factored in a modest 10 to 12% growth in the water business for FY26. And, we will only revise these numbers if we start seeing trends of our old receivables getting liquidated and industry in general starting for the new order cycle kicking in. So we're going to be observant for the next, a quarter and a half, and let's see where we are at. But assuming those modest assumptions for water business, we are still confident of getting a 20% revenue growth given the order book that we already have in hand for our other businesses in the group.
And in terms of where the railways is concerned, there is high competition here along with other issues which have led to the revenue downtick. This is not just the fourth quarter, but even in the previous quarters, we've talked about railways also as a division. So what's the approach here? Is there going to be a selective approach towards the projects that you'll undertake? What's the outlook here?
So, railway, as you are aware, as a sector, you cover other companies in the sector, has been going through competitive intensity of severity we've rarely witnessed, right? And this is across all EPC companies. Our focus is to be cautious. Last year we did FY25 revenue of 1,000 crores thereabouts in terms of revenue. And I think if you see as an overall number in our books, that's a very reasonable number. So it does not move the needle as an overall company performance. Our focus for railways is to be selective, close our ongoing projects and ensure that we take the railway business overseas. We have been at it for the last 3 to 5 years. We've been scoping several countries in Africa, looking at funded projects. And our target is over the next 24 to 36 months, focus on railway business overseas and all the 75 geographies, wherever it's relevant for the business to be our plan going forward for that sector.
Okay, so focus more on overseas for railways. Now coming to the overall order picture that is there, your total order book stands at 64,495 crore. Want to understand the execution part of it. How much is to be executed this year? What's the kind of projection in terms of new order inflows? Last year we've seen a couple of order wins which were on the larger side. So do you see more of these high ticket orders coming back for the business? So I want to get a perspective on the order inflows.
So quite a few questions from you in one question, but I'll take them one by one. I think our order inflow for FY26, given the fact that we want to maintain a ratio of between 2.25 to 3 of order book to revenue, I think we should be looking at 26 to 28,000 crores of new order wins for FY26. Yes, we are looking at large ticket items, orders which are in excess of 750 crores as a single unit order, because given our merged synergy, we have several opportunities, be it data center, airports, oil and gas, underground metro, HVDC networks, building and factories, etc., where such tenders are visible to us today. So far as our execution capability, that is where we are trying ourselves on. In the last 4 years, I think we've created one of the strongest balance sheets in the country in the sector. We have practically very, very little debt on our books. And if you look at next year, it's just mathematics. If we closed our standalone number close to 18,900 FY25, and you look at a 20% growth on that number, that's what we are looking at for our next year guidance. And we are quite confident because, last 4-5 years, we've been investing a lot in technology, a lot in mechanization at our projects. We've built a extremely high-tech center of excellence when it comes to engineering. We have a large team of multi-sectoral engineers with every possible software out there with us today, bumping up our execution capability from an engineering standpoint multifold in the last 5 years, and that focus continues. We've also set up a central, very large project monitoring group with a war room in the corporate office where we can see all our 240, 250 projects in 75 countries, live tracked on a daily basis in real time in our office in the headquarters in Mumbai. So with that kind of trust and focus, investment in technology, with over 25 startups working across various parts of our business, I think we are quite confident of getting a robust performance in FY26 on the parameters that I just told you as our guidance for various indicators of the business.
Okay, so 26,000 to 28,000 crore is the expectations in terms of where the order inflows are for FY26. But is there any selective approach or any cautiousness to the domestic bidding that we are seeing, considering that overall as a sector in infrastructure space, we are looking at for some of the companies out there increase in terms of where the receivables are. So just wanted to ask you this, are you seeing a similar increase in terms of where the receivables are concerned for Kalpataru projects?
So we don't have any problem whatsoever on any of our sectors, either domestic or international, when it comes to receivables. Water as well, if you look at our track record for the last 6 years, I think our growth CAGR has been phenomenal, right? And I don't see that as a long-term structural problem with receivables that occurred last year to persist going beyond Q4. And I think things should get back to even keel. There were as you're all aware, several uncontrolled events that happened last year. And I think even for water sector, receivable is absolutely not a problem because these are all central funded projects backed by the sovereign. So I don't see that as an issue for us.
And Amit, my last question to you would be on the capex. Now, can you just give us an outlook on in terms of where the capex plans are for the business, not just for FY26, but next 2 to 3 years, and where do you plan to deploy these funds?
So if you see our last 2-3 years capex profile compared to the last 10 years of capex that we did at Kalpataru, our last 3 years has been a pretty significant capex cycle. And, we did almost 600 to 650 crores in FY25. And that's the reason because, we've gotten into underground tunneling segment for metros. We own 6 tunnel boring machines now. Similarly, we've got single size projects in our building and factories crossing 2,000 crores of a single EPC project. So all of this, of course, required for us to spend in capex to meet the growth requirements of the future. We're looking at similar kind of number for next year, but as our strategy is to keep that more or less in line with our depreciation on an annualized basis, a little bit, plus 10-15% here and there, but keeping our overall balance sheet in check, our net working capital days below 100, our interest cost below 2% of revenue. And I think in that line, we will keep our, going forward, I see in the next 3 to 4 years, our capex coming down actually because we've invested significantly over the last 2 years and including in FY26.
Got the view, Amit. Amit, thanks so much for joining in, giving us a whole host of views on the Q4 as well as the outlook for the next year. We look forward to our conversation, but best wishes essentially for FY26 as well for you.
Thank you so very much.
Thank you so much. Let's look at how the markets are doing now, because we mentioned in